this becomes part 2, and now we are going to look at the process of formally journalizing the business transactions, and we're going to introduce a new concept. That concept is debits and credits. Now, debits and credits are very confusing if you let them be. So, the pure definition of a debit and a credit is a debit is on the left-hand side or the right-hand side. Let me rephrase that. Debits and credits are literally a position in an account. So, an asset, and that means on the left-hand side of an account when you enter a business transaction, that is a debit. On the right-hand side of an account, that is a credit. Now, if you can keep that straight, just remember left equals debit, right equals credit. So, if it is an asset account, like cash, land, accounts receivable, if you use a debit, if you want to increase that account, it is a debit on the left-hand side of the account. If you want to decrease it, it is a credit. So anything on the left-hand side of the equation increases with a debit. Anything on the right-hand side of the equation will increase with a credit. Did a light bulb just go off? To keep this equation in balance in a double entry system, debits and credits are required, or increases and decreases, but they mean different things on different sides of the equation. So on the left-hand side, where the assets are, a debit increases the account. On the right-hand side of the equation, for equity and liabilities, a credit increases those accounts. I've sent you a file that shows this. It's more blown out. It's more expanded, so that you can keep that close, because if you can remember that, you're going to be okay in this. So let's look one more time at the next one. Now they've expanded it. Our assets increase with a debit, decrease with a credit. Our liabilities decrease with a debit and increase with a credit. Now the equity accounts, let's look at those. I'm going to decrease a common stock with a debit. I'll increase it with a credit. Dividends increases with a debit and decreases with a credit. So because this is the way the equation is running here, it kind of flip-flops back and forth. Revenues, which increase your retained earnings or your equity, are going to increase with the credit and decrease with the debit, because expenses are subtracted from revenues. That's the opposite is true. Expenses increase with a debit and decrease with a credit. Same thing here with the dividends, to understand that common stock and revenues. So look, common stock is decreased by dividends, which means the opposite has to be true of their increases and decreases in each account. Again, you have to keep this handy, because you're not going to be able to totally memorize this. There are too many accounts, and you're too new at trying to understand what's going on here. So these two are very important in helping you keep things straight. Now here's an example, okay? Let's look. Assets. Okay, and these are T accounts, by the way. We're going to play with T accounts. T accounts are kind of used instead of the general ledger, because they're quicker and easier to get a visual on. So you're looking at normal balances. in accounts. So a prepaid rent, which is an asset, has a normal balance of a debit. Common stock, which is an equity account, has a normal balance of a credit, because equities have, this particular equity, common stock, where is it here, has a normal balance. Notes receivable would have, it's an asset, right? Would have a normal balance of a debit. Accounts payable is a liability. It's on the right-hand side of the equation. That's going to have a normal balance of a credit. So you can kind of see how credits and debits are used to keep everything in balance, and so that your equation is always equal, as it should be. So those are debits and credits, and we're going to play with them, so don't get too upset about them. I'm going to help you the whole way. Let's go back to journalizing now that you kind of understand a little bit about debits and credits. It'll get much clearer as we do this. Here we're looking at journalizing and posting. And we're going to, first you identify the source document, right? You analyze it with the assets and liabilities and owner's equity. That equation, is it a cash? Is it an asset? Is it a liability? What are we going to do with it? Then you're going to post it. And this is your first experience with a journal entry. It's a little teeny one, but remember the first transaction we did? That was the owner contributed $30,000 to the account, and we put it into the worksheet as $30,000 increase under equity and a $30 increase under cash. Well, originally this is set up as a journal entry, and you would write that out. Cash gets increased by 30, which is a debit, and capital gets increased by 30,000, which is a credit. And after you usually after about a week of writing these journal entries out, you will take them and then post them to the ledger. And it kind of looks like this. Here is the journal entry. You put the date in, you put the cash, and it usually has a number, so that you know where to put it at, the account number. We debit here. We have common stock. See how that's indented? And we credit. It's just a written out version of the transaction sheets we've been using. Usually put an explanation right here. So that begins the journal entries. Now, this is taking it to the general ledger, and this is just the cash. But we transfer this 30,000 down to the general ledger, and we'll show a debit right here to have our beginning balance. So here's your debits and your credits, and here's your running total balance. On December 2nd, it shows we decreased the cash account. So there's probably a, let's see, is there a, yes, there is. Here on December 2nd is a journal entry. Supplies increased, an asset increased by $2,500, and we paid $2,500 out of the cash. So decrease in cash and increase in supplies. And that gets reflected over here. December 2nd, we credit it, which deducts from, and this gives us our balance of $27,500. And what that looks like, and this is kind of busy, but you can see it. Here's your journal entries down here. They get transferred up and go to cash here, and this here, where is it? This comes down to here. This one is from here. So these are actually two different documents. Okay, this is the journal, and this is the ledger. So we record it here, and then after about a week, we take it up and actually put it into the accounts. So that's as far as we're going to go here, and we will start another video on how to analyze these for the financial statements.